welcome everyone to today's lunch and learn session with Legal Yours, Silicon Beach and Allied Legal. Before we roll into the official part, I would like to acknowledge the traditional custodians of the country we're meeting today, the people of the Eastern Kulin Nations. I pay my respect to their elders, past, present, and emerging, and extend that respect to all Aboriginal and Torres Strait Islander people that are here with us today. I also would like to acknowledge the people that are supporting us here at Silicon Beach, making this possible, that we run events like this and bring startup education and pitch nights to you all on a monthly basis. Those are our main sponsors, Silver Pen Writing Studio, Melbourne Connect, and the City of Melbourne, as well as our community and affiliate partners. Too many to mention them all, but just on top of my head, some of them: Query Law, Airvolex, Canva, Heasley Lawyers, CFO Works, Think Innovation, Carrot Cake Studio, BCF Coaching Academy, Founders Wellbeing. Please check out our website. There are a lot of those companies have special offers for the community members, where you can get from startup education all the way to mental well-being for founders and special offers for your tech infrastructure. You can get discounts on all of those things. So now to our presenters of today. Or about the session. In this session, we are going to learn about how to best take your first steps in seeking investment and protecting yourself and your idea. You will be sure to leave feeling empowered and ready to take that next leap in growing your startup. Key takeaways: this masterclass will cover getting your startup investment ready, what to look for in an investor, how to pitch your business to an investor, what is involved in due diligence process and how to prepare for this process, what are common traps and pitfalls to avoid when bringing an investor on board. I would say I'm not wasting more of your time. I head over to Talt and Christine, who know best how to introduce themselves and what they're doing at Allied Legal. So please welcome Talt and Christine, over to you.
Thanks, David. Thanks for that introduction, and thanks to Silicon Beach for putting this together. I guess I'll just say at the outset that Melbourne and Australia, we have a really good startup culture here, but we do compete with the likes of California, New York, London, Singapore, and it's really important, I think, that we all support our local ecosystem. Silicon Beach is a fantastic grassroots organization that does just that. We've presented alongside them plenty of times, and just really love to see the work that they're doing in growing and fostering this community that we all get to be a part of. Allied Legal, we pride ourselves on being an active member of that community. So we're a commercial law firm based in Melbourne, and we specialize very much in startups, innovative businesses, tech businesses. And we really enjoy being in that space. I personally, and I know that I speak for Christine and our director, Rahul, as well, get along very well with founders. You're all a very interesting, very creative, very intelligent bunch of people who are genuinely passionate about the projects that you are working on. And as somebody that has worked in, more dry areas of commercial law, I can tell you that it is a lot more fulfilling when the people that you're dealing with genuinely love the business or product or innovation that they are putting together. So that's why we're in this space. We have a lot of experience in this space, and one of the most entertaining things that we do is capital raising. But before we get into that, I'll just introduce myself and my colleague. So my name is Talt Anast, and I'm presenting today with Christine. I won't talk you through what's up there on the PowerPoint, but yeah, needless to say that we are commercial lawyers. We're specialized in this space. We both have personal experience in startups prior to coming to Allied Legal, and that interest and that exposure has only been fostered in our time here. The really fun thing I think about this presentation is that capital raising is generally the most interesting, the most exciting, and at times one of the more stressful parts of a startup's journey. It's one of the tasks that I enjoy working on the most when it comes to engaging with startups, because everybody wins, everybody's on side, and everybody's working together towards a common goal. But it is immensely complex. If you're talking about dropping $50,000, $500,000, $5 million into a high risk, high reward company, which is what startups tend to be, you want to make sure that the paperwork is correct. You want to make sure that your advisors know what they're doing, and you want to make sure that the process runs as smoothly as possible. The idea with this presentation is that hopefully by the end of it, you'll have a good idea of what to look for and what to think about when you start undergoing that process. And whether it's a, early stage family and friends round where you're only raising some 10 or 20K, or whether it's a seed with an angel or a series A, the principles are more or less the same. All that increases is the risk when the money increases as well. So with that, I'll pass it over to Christine to kick us off.
Thanks, Talt, and hi, everyone. Thank you so much for joining us today. We're really looking forward to presenting on this topic. So I'll kick off. A big part of our job as startup lawyers is to assist with capital raises, of course. We act for both sides of this type of transaction, though not at the same time, to facilitate investments from which both the investor and investee will benefit. Today, we're going to be talking about this process and covering off the types of things you should pay attention to when it comes to raising money. Towards the end, we'll also touch off on grants that startups should be aware of and give some of our insights into the grant application and assessment process. We have a tendency in the startup world to think of equity investment as the only means for raising funds, but grants and government funding can be a great source of equity and debt-free capital for new innovative businesses as well. The focus of our chat today will be on raising equity capital from a new strategic investor or investors, and we'll start off with some considerations you should be turning your mind to from the get-go. Thanks, Tal.
So this slide that's on the screen sort of just sets out what the standard capital raising journey looks like. And this also sort of sets out the framework of what we're going to be talking through today. So you sort of start with your preparation, you're gearing up. You want your founder team to all be together, all on board, have your pitch deck prepared. You want your cap table to be up to date prior to the investment starting. And maybe have an NDA in place so that when you talk to investors and start letting them get a peek under the hood, you don't have to worry about the status of your confidential information. Then you want to go through and start selecting your advisors. So a lawyer and an accountant is a good place to start. If you're talking big numbers, then a corporate advisor isn't a bad idea either. You want to get together your due diligence materials. We're going to talk through all of this throughout the presentation, but at a certain point, the investor is going to want to, look into who you are and what you're doing to make sure that the investment is worth it. You'll put in place your term sheet, which is an agreement to make an agreement with your investor. After the term sheet is signed off, you'll start putting in place your more formal legal documents, actually negotiating the deal and move through to the close. But really, as part of the gearing up phase, you want to start thinking about what you actually want from your investor, right? So obviously, money. They're an investor. They're going to be providing some level of capital in consideration of equity. But we should be thinking a little bit further than that where possible. You want to be thinking about the non-monetary value that they're going to bring to your team and to your business. For example, are they the right partner for your startup? Do they bring some level of expertise or maybe connections and contacts that will become profitable for your company? In our experience, the best startups and the ones that succeed in the early stages of their journey are those that have found investors who come on board who have some level of industry expertise that will actually be of commercial assistance. I can give you guys some examples of some startups that we have helped that were able to find the sort of ideal strategic investor. One was in the aged care space, and they brought on an investor who was a much bigger player in that space than our client was. The investor actually had overseas connections, overseas customer bases, and was able to open up these markets to our clients through its own connections, which would have been otherwise much more difficult to access for the startup. So as you can imagine, this ended up being quite profitable for our client because as well as getting the investment funds, they also got access to those new markets. Another one was a client who operated in the oil and gas space, and their strategic investment came from an angel, a Singaporean family with a very high net worth, who was just very well connected within the oil, gas, and energy sector. So having an investor with those sort of connections enabled them to be introduced to other stakeholders, other players in that space, which of course expanded their commercial and market potential. Now, obviously, those are ideal situations. And it might be the case often that your investor is just seeking a financial investor, by which we mean they aren't looking to be an active contributor to your business. That's completely fine. But if that's the case, the deal should be structured in such a way that the investor's role, which is that of a passive investor, is reflected in the agreements. For example, you should retain decision-making control, and the investor's role should really be limited to contributing funds in exchange for equity, which will hopefully generate a return for them on a, 3 to 7 year basis. Now, once you've gone through that process and thought about who your ideal investor is, maybe you found them already, and you are confident that your prospective investor is a good fit for your business, you and that investor will likely enter the disclosure and due diligence phase. Now, I want to emphasize at the outset that there are legal obligations on any company issuing shares that have to be adhered to under the Corporations Act. This includes the obligation to disclose certain information in relation to the shares and the company, which is usually in the form of a prospectus. So you'll often see a prospectus issued when a company is IPOing, going their initial public offering, for example. Exemptions do apply, though, in certain types of investments, and these are often relevant in the context of startups and early stage businesses. And these exemptions exist specifically to assist, smaller startup early stage businesses. A well-informed lawyer who understands the Corps Act and understands the space will be able to help you structure your investment in a manner that you can leverage these exemptions. And that can be really helpful because a prospectus, for example, a full-fledged disclosure document can be upwards of 100, 200 pages. They can take a very long time to prepare, and to prepare them correctly, you probably will need to engage your accountant or your lawyer. So of course, that increases the fees that you will have to incur going through the investment process. If you can leverage one of these exemptions, then you can sort of circumvent that process. Now, even if you can circumvent it, even if an exemption does apply, 9 times out of 10, an investor, particularly a sophisticated or professional investor, so not a family or friend, but an angel or a VC, are going to expect a reasonable level of information about your company, whether or not the Corporations Act exempts it. And you have to ensure that what you're disclosing to your investor is not going to mislead or deceive them in any way. You can get under big trouble by ASIC if you share any misleading or deceptive information with a potential investor. So a good way to be ready to share this information is with your pitch deck, which you'll remember from the last slide is something which we recommend preparing earlier on. And your pitch deck will include information that your investor will be wanting to see. Things like a breakdown of your product or service, an explanation of what solution this product or service is bringing to the market. So in other words, what gap is it filling? They'll want to see some market analysis around your product. Why are customers going to pay for this? And not only why, but who is your target market? Is it a growth market? Is it a niche market? They're going to want to see this breakdown for 2 reasons. One, obviously, because it all speaks to how potentially profitable what you're doing is, but also they need to see that you've actually done this work and undertaken those processes and those thought experiments yourself. Part of your market analysis should also be who is your competition and why are you better than them and why are you going to be able to compete against them in this space. Something which is really important is your team. They're going to want to know who your management and founding team is and why the investor should trust them. The team behind a startup's idea is often more important than the idea itself. You may have something which is really novel, really exciting, and highly profitable, but if the right people aren't behind that idea, then it is effectively worthless. They say everybody has some $10 billion ideas in their lifetime, but it's a very different thing to actually be able to drive that idea to commercialization and fruition. One of our highest valued startups in terms of their valuation from their recent funding round are not doing anything particularly new in the markets. They're doing something which a couple of other companies have been doing quite successfully, but because the team behind it is so experienced, so professional, so driven, they have done incredibly successfully and raised over, I think, $200 million in funding over the last 2 years. So that's just an example of how important that team is. They're going to want to see as well the current financial status of your company. So whether you're in the revenue, pre-revenue, post-revenue stage, if you are generating revenue, what sort of profit margins are you seeing? And if you're not generating revenue, are you far off? They'll want to see basic financial statements, balance sheets. This will all help the startup and the investor work out the value of the startup that they're investing in. And your pitch should also explain why you need the investment. The investor is going to want to know what you're actually going to be doing with their money and why this will lead to return on their investment. It's common to see in term sheets or subscription agreements with professional investors specific requirements on how the funding can be spent, right? It will often say that the money can't be spent to pay off debts, or it can't be spent to pay out dividends. It has to be set for either operational expenses or perhaps something even more specific, right? Now, those sort of parameters can be a good indication of a good investor versus a bad investor. Generally, the more conditionality that comes with the investment that they're giving you, that can often be a red flag, right? If they are trying to limit that to highly specific expenditure, then that can often be too restrictive. You want to have enough flexibility to manage your business in the way that, a founder and a CEO should be able to manage their own business. As well as this pitch deck, which you'll be able to share with them, they're going to likely want to conduct their own due diligence into the company that goes over and above this. So before getting into that process, there are a couple of things that usually need to get covered off. And one is an NDA. This due diligence process is effectively a peek under the hood. They're going to be looking into all sorts of confidential, valuable information and intellectual property, your financial status, your market analysis, the IP and trade secrets that actually form your product. And it is highly reasonable to ask as part of that process that they agree to not share that information with anybody else. You obviously don't want an investor, looking at your IP and then taking it and giving it to one of their other investments or trying to commercialize it themselves. Something an investor might ask for, which is not at all unreasonable, is a period of exclusivity to negotiate the deal. Depending on who you are, they don't want this to become a process where they are effectively getting into a bidding war with other angels or VCs. So it's pretty often to see something like 1 month or 60 days of exclusivity where they can focus on you or your startup, and they can do that knowing that you're not talking to any other investors. There's nothing wrong with this, subject to it not being a, excessive period of time. If they're asking for 6 months, 12 months, then that probably goes too far. But 30 days, 60 days, that's generally what we see, and that's generally pretty reasonable. And immediately prior to the due diligence, you'll probably start negotiating the term sheet with your investors, which is going to cover off on things like the structure, the size of the investment, any agreed conditions at the outset. This will generally be non-binding, and any sort of binding agreement will usually be conditional on the parties entering into a more formal agreement like a subscription agreement. But the benefit of having your term sheet in place is that before you commence all of this due diligence and NDAs and pitch decks, you can at least agree on, okay, you're going to be investing X amount of money and it's going to be invested for X percentage of equity, right? If those fundamental commercial details are agreed at the outset, that usually makes the due diligence a lot more valuable and useful. Now, really good startups are prepared for this due diligence process. The best startups and the best examples that we see is when the startup is not being reactive, i.e. you're not waiting for the investor to give you a checklist and then you start trying to comply like you're responding to an audit or something. Have in place ahead of time a file or a folder, maybe based in the cloud, where all of the information is stored. It's easy to navigate, it's clear, it's concise. You can share that with your investor, and that looks a lot better to them than trying to scrape information and sharing PDFs and Excel spreadsheets for them in an ad hoc manner. The reason why they're going through this process is because they are trying to figure out a couple of things. One is, what is the value of your business, right? Like, what is their investment actually worth? So you should have in place the sort of information that we discussed around financial projections, business and marketing plans. They're also going to want to know that your intellectual property is secure, and they're going to want to know where it is held. We often see startups who are, offering digital platforms like websites or SaaSes, and they have this website or the software built or developed prior to actually registering their company. This isn't an IP presentation, so I won't get too far into it, but to cut a long story short, in that situation, when IP is created before the registration of the company, then the company doesn't automatically own the IP. The individual people who worked on that IP own it. So if you have a software developer and a graphic designer and a marketer and somebody writing up business plans, all that IP is split between those individual team members. And an investor has no interest in that. They're buying into a company. That company's biggest asset is its IP. So that company better own that IP. We often see VCs, the term of their investment is that they actually require all founders to sign a deed assigning IP into the company. It's helpful to have that in place before the investor even gets there. Have all of your founders transfer all IP into the company. That way an investor knows that that asset is secure and is owned by the company they're buying into. They want to know that your product or your service or whatever it is actually works and is functional. It won't be unusual for an investor to ask to see a working prototype of what you are putting together. Don't try to avoid this because one of the best ways to get someone, especially an investor, excited about what you're doing is by showing them and letting them have the customer experience. Depending on what stage they're coming in, you may have something which is more advanced, or you may have something which is early on, but in either case, try to stress test that before you show it to the investor. You don't want to be in a situation where you are doing a demonstration that goes faulty halfway through when someone is considering investing $500,000 into your company. And they also might want to see the agreements that you have in place prior to the investment. So, you might be at a stage where, as well as your founders, you have some employees, you have some contractors, you have some customers, you have some suppliers. If those are all on the back of handshakes and envelopes, that makes your startup look messy. If those are all in, airtight boilerplate signed agreements, then that makes your startup look tidy. And that gives the investor confidence in what they're buying into. Lack of agreements or poorly drafted agreements, they create uncertainty about the rights, obligations, entitlements of integral members of your team or of third-party suppliers or employees. And that poses a risk for an investor. When they buy shares in the company, they're an owner of the company, which means that they potentially share in the liability of that company. Now, if you don't have agreements in place, if you have these sort of arrangements already at the moment, then it's not too late to put an agreement in place. You can have them implemented retrospectively. And this goes a long way to legitimizing who you are and what you're doing. You might not have any customers, in which case, obviously, customer agreements is a bit of a moot point. But even if that's the case, you can still try to procure some level of formally documented market interest, maybe in the way of a letter of intent from potential clients or a letter of functionality for a pilot program that you've done with something like a university or a large company. And all of this will go a long way to legitimizing the marketability of what you're doing and therefore encouraging their investments. I'll pass it over to Christine to talk to you a bit about structuring.
Thanks, Talt. So if all parties are still keen to proceed after the disclosure and due diligence phase, you'll need to determine how to actually structure the investment. There are a number of ways to structure a capital raise, which will very often be governed by the investor's preference. Some common structures include an equity investment, which is an investment through the acquisition of shares in the company. In an equity investment, ordinary or preference shares can be issued. To the extent that preference shares are issued, they usually attach special rights to benefit the investor. This includes anti-dilution rights and liquidation preference rights. In both cases, there is likely to be a negotiation over other aspects, including board positions, the decision-making regime of the business, amongst other things. You can also structure the investment through something called a quasi-debt instrument, such as a convertible note. A convertible note is an instrument pursuant to which the investor lends money to the company and usually has the option to have that either repaid or converted into equity at a future time. The disadvantage of a convertible note is that as a quasi-debt instrument, it places a repayment obligation on the startup, which, as we know in the startup context, can place undue pressure on a scaling and growing business. At times, they even have provisions that apply interest on the debt. This can be quite onerous on startups, which tend to be higher risk investments. Convertible notes can also take a little longer to negotiate. From an investor's perspective, they can be attractive as they provide optionality of repayment or equity conversion. And another common structure is a simple agreement for future equity, or otherwise known as a safe note, which I'm sure many of you have heard of. Safes are becoming more and more popular in the startup context. It involves the investor giving your startup an agreed amount of money in exchange for the right to acquire shares in your company at a future date. The value at which such shares are acquired is normally determined by the valuation of the very next raise your startup undertakes. In certain instances, the investor may seek a discount, so they get an advantage in that they gave you the money. It's a very simple instrument, hence its name. Convertible notes can often take some time to negotiate and settle due to provisions relating to interest and repayment needing to be ironed out. Safes, on the other hand, are appealing due to their relatively simple nature, as they're much easier to put in place compared to convertible notes. They've become very popular as an instrument of choice, as it recognises it can be difficult to value startups. They allow investors to provide funding quickly and leave the question of value to a time later in the future when the startup does undertake its next raise. An experienced or sophisticated investor is likely going to have their own preference for an investment structure, which of course is not surprising. They might want to structure an investment that is most favourable to them and that allows them a clean, medium-term exit strategy. As an early stage startup, you want to be able to balance your need for a financial investment with the requirements that the investor is asking for. This is where it can be really helpful to have a lawyer on your team. Having a lawyer help in this part of the process yields many advantages, but I'll discuss two. Firstly, we will be able to more accurately predict or explain the ramifications of an investor's preferred investment structure. Not only that, good lawyers are good negotiators. So if the potential investor is trying to leverage their financial position to wrangle a deal that gives them too much control, a lawyer can help bring some balance back to the table. In terms of rips and traps, we have seen investors present clients with structures which are presented as equity investments, but at closer look at the underlying legal documentation, it's clearly something more than that. For example, what we have seen at times is startups being presented with subscription agreements, which have provisions in them relating to guaranteed returns. For example, one of our clients presented with a subscription agreement, which provided the investor with a guaranteed return after a 5-year period. The investor was surprisingly a well-established brand in the startup world. This structure was clearly problematic, as while it was presented as an equity investment, the guaranteed return in favour of the investor meant it was more akin to a loan arrangement. The startup is effectively agreeing to issue shares in consideration of the investment, but also has to guarantee the return over 5 years. As you all will appreciate, in the startup world, a guaranteed return is often not in keeping with the commercial reality of investing in a new risk-based venture, which is usually seen as high risk, high return. We were able to engage with the investor in this case and had the legal agreement updated to remove the guaranteed return. The investment then proceeded on the basis of what was more akin to a share acquisition, so our client was really happy with that outcome. Throughout the structuring process, you will likely be in negotiations with your investor, and there is a good chance that the investor will be looking to gain as much as they can from the deal. They may seek to gain some level of control by, for example, seeking the right to appoint one or more representatives to the company's board. This would give the investor a degree of influence over how the company conducts its business, as well as giving the investor a higher degree of access to the company's information. The right to appoint a board member and, for example, how many board members an investor can actually appoint is likely to be proportional to the stake of the company that the investor will acquire. Giving them some control should not, however, always be deemed a negative thing. In fact, if they know what they're doing, it could actually be a good thing, a really great thing, actually. These sorts of entitlements and obligations will be set out in your shareholders agreement. We'll discuss this more in the key agreements part of the presentation, which is coming up. An investor may also seek certain other rights to protect its investment, such as veto rights over key company decisions. This might relate to a change in the business direction, acquisitions or disposals of assets, preparing budgets and business plans, or planning further capital raises. The degree and extent of control an investor has over your startup is always a matter for negotiation. That being said, as a player in the startup world, you need to be comfortable with the fact that no one is going to be handing out money without getting some level of control. That's just the stark reality of the world we live in. That's again where it is important to make sure you have the right investor. Remember though, until the shares are issued, this is all up for negotiation. You shouldn't turn down an investor because they are seeking for something you don't want to give. Similarly, you can expect that an investor won't walk away because you want to negotiate. If an investor is making these sorts of demands, it shows that they're interested in your company and that they believe your company is going to generate a return for them. This means you have something they want, and that gives you the negotiating power. In theory, a good negotiation is where both parties get what they want. Whilst this doesn't always happen in reality, it does set a nice standard of what you should be aiming for in a negotiation, which is a good compromise. An experienced investor won't walk away from a negotiation as long as you're being respectful, reasonable, and realistic. In fact, by showing a capacity to negotiate, you might even showcase to your investor that you have a degree of commercial acumen, thus encouraging the investment, if anything. So we'll move on to key agreements after I take a sip of water.
Before we get on to key agreements, I'll just answer some of the questions in the chat because they're in response to that specific slide. First was with David, which is what are the consequences if the investor wants their money back and the startup does not have it? So if you are dealing with some version of debt equity, it's a debt and it's dealt with in the same way that a debt is always dealt with. If someone is unable to repay principal and an interest on a debt, then a creditor, which is someone who is owed the money, has a couple of options. They can issue a statutory demand to have the company wound up. They can sue in small claims court or a larger court, depending on the size of the debts. But ultimately, they say never sue someone who's poor, because if there's no assets and there's no cash on hand, then you're ultimately not going to recover anything back. So I guess, the second part to your question, David, is not just if they don't have the money, but also if they don't have the assets. If they can force a sale of the assets to repay the money, then that's usually the steps that they will take. That's in the case of a debt one. If it's just an equity investment with no debt component to it, then a bad investment is just a bad investment. And professional investors usually have that failure and success margin, written into the amount of money that they're playing with, right? If you're a venture capital playing with $1 billion, you invest in 20 startups, you expect 15 of them to fail, and the ones that succeed balance out the failures. And that's just the nature of this game. Tom asked, was the guaranteed return hidden in the details or was it in plain sight? Not to be funny, it's kind of a tough question to answer as a lawyer because we read the whole contract, so nothing's really hidden. It wasn't something which they, had tried to write in a way that, would mislead a person reading the contract, but it wasn't in front or center in the key terms either. It was one of the clauses in a 20-page agreement, and it required a guaranteed return on the investment. So generally, there's no really hiding things in contracts, because to the extent that they are being reviewed closely, everything is going to be reviewed. And to the extent that something is written in such a way that is intentionally confusing, you can generally have those struck out by a court. That's all general and depending on what it actually says. But so cool. We can keep on moving on unless anyone has any more questions about, the structuring side of things. And otherwise we'll have Q&A at the end. Back over to you, Christine.
Thank you. Good questions, guys. Keep them coming. All right. So key agreements. The terms you agree to at the end of these negotiations need to be well documented within your key capital raise agreements. And it's critical that you have your key agreements in place throughout the whole process. These include things like an NDA, non-disclosure agreement, which Talt did touch on earlier on. This is where you'll be sharing financial and commercial sensitive information throughout the process. So it's really important to have an NDA in place for that reason. And this should be done from the outset so that you're protected throughout the due diligence process. Also, a term sheet. The term sheet is typically non-binding and sets out the expected terms of the due diligence and disclosure process, as well as other terms that will guide the investment process and the finalized agreements. Often in the case of sophisticated investors, they're likely to issue their own term sheet to you. Another agreement is something called a subscription agreement. This is between the company and the investor and sets out the terms of the investment. So a very important agreement. This is the legally binding agreement pursuant to which the investor acquires shares in your company. It will cover off things like price and payment, time for completion, and any special rights the investor will have. And another very important agreement is something called the shareholders agreement. So it will be a condition of the subscription agreement that the investor signs the shareholders agreement. The shareholders agreement sets out the rights and obligations of all shareholders in relation to the company. For example, who will manage the business, how directors are appointed and removed, how decisions are to be made at director and shareholder level, how disputes are to be resolved, what happens if a shareholder wants to exit, etc., etc. Many things, many important things. As mentioned before, if the investor is more of a passive financial investor, then the shareholders agreement should make it clear that they don't have the right to appoint directors, veto decisions, or carry substantial voting power. Conversely, if they're a more involved investor, they will want all of those rights. And finally, if it is a quasi-debt investment, then you will need a convertible note agreement in place, or if it's a safe investment, you'll need a safe note in place, both of which we've already discussed. So we're going to raise slide now. Talt will speak to that.
So this slide is, don't take this as a Bible, because these numbers and, these phases are more general than set in stone, but it is a fairly decent summary of what the various capital raising rounds that your typical startup will go through. The very first round, that's your family and friends round, right? It's usually small amounts. We've seen investments in this round as low as $5,000 from, family and friends, as high as $50,000 from family and friends. It's generally, lower risk compared to your venture capitals because it's a lower amount of money, and you still need the right agreements in place. You should still have a shareholders agreement. You should still have a subscription agreement. Someone's put up here, you should have love. That's, yes, it's like a beautiful thing, better than money. And what would be contained in those agreements would generally be less complex than what you would see in a higher value agreement. So one of the key things in a subscription agreement, for example, is the warranty regime, where the company being invested in provides a bunch of warranties to the investor. And these are warranties like, all of our tax obligations have been complied with. There is no litigation on foot or threatened against the company, basically saying that your investment is not coming with a level of risk. And if one of those warranties turns out to be untrue or a lie, then the investor has the right to, sue up to the amount that they've invested in the company. For a family or friends round, we'll usually have a warranty regime that's about a half a page. On the flip side, we had a investment which was about a $13 million investment, and the warranty regime came to about 16 pages, right? You still have your warranties, but the more money that's being invested, 50 million versus 50,000, you obviously want a greater degree of protection. As you move through these rounds, that scales proportionally. When you're talking with your angels, maybe you're developing your MVP, you're looking at the amounts in the, high tens, low hundreds of $1,000s. You still want to have all your same agreements, but those agreements are going to become more complex. When you get to your, up to $500,000, you're going to still be talking with perhaps angels, perhaps VCs, and the higher you get, then the greater all of those processes increase. You can sort of see that at this 500K, you're going to have all of your correct agreements in place, and then those just get more complex as you go through it all. So this provides like a good general overview, but like I said, don't take it as a Bible. We've seen people who are bootstrapped right up until the VC phase, and we see people who have several family and friends round before they even start talking to angels. There's no one way to go about this, but there are general rules that need to be followed. Have the correct agreements in place, keep things professional. Even when you're dealing with friends and family, you want to keep things professional. If only for your own personal interest. You don't want a relationship sour between you and a cousin or something because you just didn't document things correctly. And unfortunately, that happens all the time. Cool. So look, that sort of covers off equity funding. To close things off, we're just going to touch pretty quickly on grants. Grants are a nice alternative means of raising capital. They generally don't come with equity, so it can be viewed as a more strings attached way of raising capital. And there are lots of grants available at the state and federal level, and a lot of them are appropriate for startups. What we often find is that startups simply aren't aware of how many grants they might qualify for. And what we've also found, though, is that while grants and the grant process is meant to be fairly user-friendly, and that the application and assessment process should be comprehensible to the average small business owner, not to be critical of government, but often the time this just isn't the case. It's entrenched in bureaucracy, legislation, rules, and guidelines. They have complex frameworks when it comes to determining your eligibility, and it can be helpful to have a lawyer or an accountant or a grant writer on side when you're going through this process. There are a couple of year-round grants that we often recommend looking into. One of these is the Accelerating Commercialization Grant, also known as the ACG. The ACG is available year-round. It provides up to $1 million in matched funding. So this means that if the government is prepared to release $500,000 to you, you have to show that you can put up $500,000 yourself. That money can come from investors, that money can come from debts, but it cannot come from another government grant. The purpose of the ACG is to specifically assist startups that find themselves in the valley of death. For those of you who are unfamiliar with the valley of death, what that means is that you have raised all of the money that you can raise. You've tapped out your potential pool of investors, but you're still short of what you need to get to market and start generating revenue. And it's called the valley of death because you can't get any more money, but you need more money in order to start making money. If you find yourself in that situation, that's where the ACG steps in. And the reason why it's match funding is because you might say, look, I need $1 million to finish my MVP, get to market, and start generating revenue. I have only been able to raise $500,000. So the government might be able to front the other half of that budget that you require. The process of it is, it sort of runs in the first stage like a pseudo accelerator. You apply for what they call commercial guidance and assistance. They pair you up with some people from their grant team who actually come in and they do an audit of your business. They try to actually help you get to a stage where maybe you don't need the grant funding. After that process, they then approve you for the grant, and it can take generally like 3 to 8 months from application to actually be approved for the money. It is competitive, which means that even if you tick all of the boxes, it's still a discretionary call from the grants team, and they generally focus on for-purpose or startups that will be generating a lot of jobs. So if you find yourself in that situation, then the ACG is a good one to look at. Another grant is the Export Market Development Grant, also known as the EMDG. Previously, the EMDG was a reimbursement scheme that operated similar to R&D, where you incur the funds first and then you get it back afterwards. But from 1st of July, I believe last year, they switched it to a grant program, sort of in response to the pandemic and to help businesses, gain some momentum. And that means that as of last year, EMDG applicants can receive funds in advance as opposed to retrospectively. So this is a grant that helps businesses export a novel product into new overseas markets or expand their current export efforts. To be eligible for it, you have to be a business, whether sole trader or company or partnership, and you have to meet the turnover test, which basically means you have a turnover of less than $20 million in the immediately preceding financial year. There's some up to $800,000+ available in match funding over an 8-year process, because there are various stages of the EMDG that you can apply for. The first stage is making your first sales in an overseas jurisdiction, and then it is expanding those sales, and then it is expanding those sales even further, and each stage releases a large amount of funding. There are also lots of other grants that you may be eligible for. The EMDG and the ACG are 2 grants that are generally available all year round and are generally appropriate for startups, but grants come and go. They go up for 3 months. They focus on specific industries. They focus on specific problems, and it's not a bad idea to subscribe to, one of the government websites that releases updates on grants, and just have it in your calendar to check them on a monthly basis to see if there's anything that is being tailored for your specific industry. They often are releasing stuff for things like tourism, for Indigenous-owned businesses, for female-led startups. And yeah, being aware of that can be a good way to get funding quickly without strings attached. So with that, that covers off the equity fundraising process and just a little bit of grant information to pique your interest. We'll pass it over to you guys now for some Q&A. We already have a couple of questions in the chat, so I'll address those as the starting points. And if you want to ask any questions, you can either drop it in the chat, or if you would like to, just feel free to unmute yourself and turn your camera on, and we can just have a conversation while everybody listens. Starting with Mick. Mick has asked, if a potential investor is about to set up a company that may compete with yours, is that an insurmountable conflict? Personally, I have never seen such a situation, because I can't think of a situation where somebody would want to invest in their own competitor. And if you are in that situation, I would be asking why. Why is this investor who is setting up something which competes with me wanting to invest in me? It seems sort of unusual. I think
perhaps the way I asked the question wasn't that great, Talt, because I have a potential investor who may go on to set up his own company, is really what I'm saying. So if he were to invest in me, would that preclude him from going and setting up his own company at some point? He may want to do what I'm trying to do, but in a much, much bigger scale.
So that's where would it preclude him? No, unless your agreements do. So shareholders' agreements often come with restraints of trade and anti-compete, non-compete clauses, right? Mm-hmm. And they aren't necessarily fixed in stone, right? Like, they generally don't apply to a shareholder. For example, let's say that I own 20% of your company. There will likely be a clause in the shareholder agreement saying that I cannot invest in a competing company unless the investment is for less than 5%, right? So I can have minor shareholding in competing companies. It might say that I can't go and be employed by a competitor, right? But it may qualify that by saying, unless that's the only way that I can earn a living, right? Because the court will never enforce something which results in one being unemployed. If you want your investor to have that ability, if you want them to be free to go and enter a competing company, then just don't have any of those clauses in there. I personally wouldn't recommend it, because they're effectively going to be seeing all of your IP, all of your confidential financial information, and then, take that and use it for their own commercial benefit. That poses a bit of a risk to you. So it is definitely, I guess, a judgment call. But then the follow-up question is, if they are looking to set up something in competition to you, why not work with them? Why not?
That's a possibility. I guess the investor that I have in mind is a little uncertain about what their next move is going to be. They made an enormous amount of money. I know they want to invest in various different things. Mm-hmm. They themselves don't know if they have the heart to go and set up another company like the one they sold, or if they would invest in the one that I want to set up. And so I guess what I'm wondering is, if I get them to invest in my company, am I effectively precluding them from in the future going and setting up something else in a similar or the same field? Because I imagine that's a question they'd be asking themselves as well.
Yeah, so it would only be if, like I said, if you had the terms of those agreements that would be precluding them from that. Now, I would highly recommend having those terms in your standard agreements. Yeah, because you don't want people to compete with you by using your own proprietary information. But there's nothing that would necessarily just by default stop them, and ultimately you would have to take that action against them anyway, right? Because contracts aren't statute. You can breach a contract. It's not a criminal act. The consequence is that the other party to the contract can sue you, right? So you would actually have to take some sort of positive action to prevent the investor from doing that. Hopefully that answers your question.
Yeah, I think so. Thank you.
Yeah, cool. Simon asked, do we have any opinion on prospecting investors or even buyers? Simon, can you expand on that a little bit? Let's see, do we have Simon in here still?
You got me? Hello?
Yeah, Simon, there you are. Yeah. So yeah, what did you mean by that?
Okay.
Yeah.
Thanks. So I have an established business in the UK.
Cool.
It's been around for a while, and I'm going to in the process of starting that up over here. So it's a two-part question, really. One is if I wanted to exit my business or get investment for new initiatives we're looking at, what is a good way to prospect in that? So to contact potential investors, whether you have any guidance on that. And the other would be if I'm establishing a mirror business over here in Australia, how might some investment be approached with that, because it's a separate entity and yet it's doing pretty much a similar thing. So it's using a lot of the IP,
Sure.
Separate company, but using a lot of the IP from the
Sure.
UK.
In terms of prospecting buyers, there's a lot of different ways that people go around doing it. I mean, everything from, I know that there are just websites out there where people list business acquisition opportunities. You can approach a broker or a financial advisor, or you can just talk to people within your own network. A good starting point when it comes to prospecting them is, you may have heard of a non-binding letter of intent or a non-binding expression of interest. Yeah, where a prospective buyer basically submits a proposition and they say, we are willing to buy it for this much money. We want to buy it pursuant to an asset sale or a share sale, and here are the reasons why we are a good buyer. And that non-binding letter of intent sort of serves a similar purpose to a term sheet, right? It sort of sets the framework for the agreements that will eventually be put in place.
Sure.
Yeah, so it's, yeah.
Can I just ask, so the term pitch deck, would you ever send something similar if, say, I'm cold prospecting someone? So say it's you and I'm reaching out to you and say I'm interested in talking to you about this. You're a busy guy. This is what we're about. Are there any structures to approach that you would recommend?
Like, you want to send me a proposal to buy your business?
Yeah.
Yeah, absolutely. So, you think about the sort of things that a buyer wants to know. They want to know what's the year-on-year EBITDA. They want to know what are the financial projections. They want to know how the company has performed for the last 5 years. And all of that can be collated into a, well-written, easy to read, basically just a proposal, which sets out that information for them. And that will, that's just to attract their interest.
Sure.
And then if they're interested in that, you can, start dealing with those
sure.
more complex, like pitch decks and actual financial details.
Gotcha.
Generally speaking, though, somebody buying a business, they will, even if they're a busy person, we have clients who just forward all that information to us and say, just read this and tell me what it all means, right? So it's often something which gets handled by the advisory team.
Okay, interesting. All right, so there's no legal statute or approach in particular with regard to that prospecting that you would?
Not for private companies in Australia. If you're talking a UK business, I'm not familiar with UK law. So I can't really advise on that, but that's how, I can tell you that's how we have assisted our clients, has been through proposals, non-binding letters of intent, and then getting into the more complex due diligence material from there.
Yeah, gotcha. Okay, brilliant. Thank you very much.
Yeah, and then when it comes to going overseas, right? You could even do a flip up instead of selling your UK business, which is where the UK business, where you set up a company in Australia, and then you put in place all the paperwork between an Australian team and a UK team to transfer all of the assets, IP, shares, cash on hand, everything that the UK company holds. You transfer it to the ownership of the Australian company, and then sort of simultaneously deregister the UK company. And that's called an international flip up, where you are effectively transferring your whole company overseas to continue running with all of those assets, all of that IP in Australia. Because if you're setting up the same thing in Australia, you don't necessarily want to sell your IP or get rid of all your assets to a UK buyer. You may want to keep those for your Australian company. And realistically, a UK buyer might not want to buy a company with the knowledge that the exact same thing is going to be setting up in Australia and therefore potentially competing with it.
Yeah, I got you. Yeah. Great. Thank you.
Yep. Cool, no worries. Tom B asked, have I seen that occur? I assume you're asking in relation to the investor setting up a competing company. Is that correct, Tom? that's what that, yep, cool. So I personally haven't seen that occur. Usually the investors that we deal with we generally act on behalf of the startup. And we generally deal with one of three types of professional investors, right? So ignoring friends and family, the three types of professional investors that we deal with are a angel, right? So a high net worth individual who often is retired or maybe just has a lot of money and they're looking to invest in potentially lucrative opportunities. And venture capitals. The difference between a venture capital and angel, if you're not aware, is that an angel invests their own money, a venture capital invests other people's money, right? So a venture capital fund might have $1 billion, which comes from 30 different investors. They pool those funds and invest it on behalf of their own stakeholders. Angels and venture capitals, that is usually what they do for a living. They're generally not setting up their own companies. They are investing in companies, and that is their business. That is what they do. So it's not really high risk that a venture capital whose entire job is investing in startups is going to start their own startup. What is more realistic is that they will invest in other competitive startups, right? And that is something which just happens. And that is generally okay, because if they're buying in for 5% or 10%, then there isn't too much of a conflict of interest there. Obviously, all of this is fluid and all of this depends on the certain circumstances at play. Or the other type of investor is where they are, again, a high net worth individual in the same industry. And in a way, they already do compete. But I'll give you an example. One of our clients has been a dentist for about 15 years. And in that time working as a dentist, sort of realized if I had this specific type of practice management software, it would make my life a lot easier. So I assume other dentists would use it as well. I'm going to build that and I'm going to sell that to people within my own industry. And that founder has raised investment from other dentists who think to themselves, yeah, I could also use this product. So I believe in them. I'm going to invest in them as well. So those are the three types of investors that we usually see. And there generally isn't much of a competition risk in those scenarios.
Can I ask one other question?
Yeah, by all means.
In this space, especially to the uninitiated, is it predatory? So let's say, have you seen a situation where someone has a great idea or something that sounds fairly solid, and where the potential investors are approaching it from predatory, take advantage, assume control, and really kind of take advantage of that? Do you see that very frequently? Is it something that occurs, or does it tend to be handled by all the documentation and the legalities that you've covered?
Yeah, so those are sort of the horror stories, I think, that a lot of startups and founders have heard of. I've spoken to a lot of founders who say that they don't want investment because everybody's heard of somebody who blamed the downfall of their business on an investor who tried to take too much control. And that is not made up, that can happen. There can be unreasonable investors. And like I mentioned at the start, there are red flags to look out for, right? So a couple of red flags that we've seen, which we've, had to negotiate out of the agreements. And this is just to give you an idea of what to look for. Hopefully you guys all know about the way that dilution works, but just a quick crash course. Let's say that I buy in for 20%, and then in a year, more shares are issued. My 20% gets diluted down to 15%, and then more shares are issued. My 15 gets diluted all the way down to whatever percentage if I'm not continuously investing. They wanted a clause in there saying that regardless of how diluted their shareholding got, and they were initially buying it at 20%, no matter how diluted their shareholding got, they wanted veto rights over every major decision that the company was going to make. And that was, from our perspective, highly unreasonable, because if they got diluted down to 10%, 5%, 1%, but they still want to be able to make veto decisions over things like raising new capital, over things like IPOing, that's just too much power for a diluted shareholder to have, right? So another is if they are buying in for a small percentage, like 5 or 10%, but they want a level of control that doesn't reflect that. If they're buying in for 5%, but they want to have 2 directors appointed to the board, or if they're buying in for 5%, but they, want to have all decisions run by them for the first 5 years, just things like this, which give them a lot of power. That's generally what to look out for. A lot of the time they will ask for that. And then as soon as you say, no, get rid of it, they'll be like, okay, that's fair enough, you know, because often, look, we do it as well as lawyers. We put stuff in favor of our clients and we tell our client, look, 10 out of 10 chance this gets knocked back, but we might as well put it in and just see what best outcome we can get. Yeah, so there's nothing insidious about it. It's just the way that people do business. So when you're seeing those things, ask to have them removed. And if they say no, then that is probably a red flag. But what I will say is that every successful startup that I've worked with, and by successful, I mean hitting 10 million, 20 million, $30 million valuations, generating revenue to the point where the founders are not just sustaining themselves, but generating high profits off the startup that they built, where they're building their team, they're expanding. All of them have venture capital funding. There's not a single one of them that I work with that doesn't have a Scalata or a Blackbirds or an Antler or one of your big VCs sitting on their cap table. They've usually gotten them early on, anywhere from $200,000 to $5 million of investment in the first couple of years. And those are the ones who go on to be successful because you just need that backing. And the good venture capitals, like some of the ones that I've just mentioned, who we've worked with and are generally reliable, they have a vested interest in your startup succeeding. Like, it doesn't make sense for them commercially to ruin your startup. They actually want to see you succeed because then they will get their return on their investment. So the good VCs, the ones that are reputable, will generally, if they are making decisions or trying to leverage some sort of control, they often make the right decisions because they've been in this game for a long time. They know what they're doing. They know what the startup world looks like, and that can actually be to your advantage. So there's no rule. It's just a matter of being commercial, thinking commercially, paying attention to what is actually being asked for, and making sure that everything is fair on both sides. And you know, you give some, you get some. You're going to give up some control, but you're going to get some money as a result, and that's what really makes this world go round. Thanks, Bilal. See you next time. Josh Snyder. Any relation to Zack Snyder? Can you offer any advice regarding which company structure is best for having investors, specifically LLC versus corporation? Can an LLC still court angels and VCs despite not being able to issue shares of stock? Josh, are you American by any chance? I'm going to assume that you are, because those.
Yes, I am.
Yeah, okay. In Australia, I too, as you might have gathered from my accent, we don't have LLCs, we have P2I LTDs. In Australia, there are 4 common business structures, not company structures, business structures. You have a sole practitioner or a sole trader, which is just somebody acting on their own behalf. You have a partnership, which is multiple people acting on their own behalf. You have a trust. A trust is a weird beast, but it's basically just a vessel to hold assets, which comes with certain tax advantages. It's generally used for investing in property or investing in shares or companies, or you have a company. A company is a distinct legal entity that has its own legal personality. A company has all of the same rights that an individual has other than human rights. For example, a company can't be married. Thanks, Rob. We'll talk to you next time. And a company is the only common business structure that can really raise investment through the issue of shares, because a sole trader, obviously you can't, sell your arm. You can't sell shares in yourself. A company can sell the shares in its company, and investors will pay money for those shares. So anytime that you're looking to raise investments, a proprietary limited company is really the only way to do it, unless you want to deal with debt, which we advise against. And Josh, despite my accent, I've never trained nor practiced law in America, so I can't really advise on the best American company structure.
Got it. Thank you.
Cool. Any further questions? We'll give everybody a few minutes to think about whether they want to ask any more questions. In the meantime, I'll just say, first of all, thank you all for coming. Hopefully you enjoyed, and hopefully you can, take some things away from this that you can put into practice. Christine and I have both dropped our LinkedIns in the chat. I'd highly encourage you to connect with us and just reach out if you have any questions. our team, Allied Legal, we operate on an entirely fixed fee basis, which means that you're not going to get any surprise or unexpected bills. And 9 times out of 10, if you hit me up on LinkedIn with a question, I'll generally just answer that question. If it's something which is fairly simple and straightforward, if it's something complex, I'll let you know in advance before I charge you for any of that advice. But we genuinely do like engaging with founders and seeing this space succeed. So yeah, get in touch, reach out, and we can have a chat. We also offer 30-minute complimentary consultations. So I, again, really encourage you to take advantage of that, because we generally share as much advice and information as we can in those sessions. Yeah.
Thank you so much, Christine and Talt, for this great session.